Hello, and welcome to today's episode of Street Smarts with Howe and Rustling. I'm Vince Carson, certified public accountant and financial planner at Howe and Rustling. In today's episode, we're going to be going over a tax-saving tip for individual taxpayers to consider that are beyond the obvious. The subject of today's tax-saving tip is the Backdoor Roth IRA. Income taxes are, for most of us, the largest expense item that we incur throughout the year. Therefore, with regards to your personal finance, it's very important to address this area in order to make sure that we're utilizing all of the tax code to our advantage. As many of you know, the first move in lowering your tax liability is to max out your 401k or IRA contributions. But what if you've been phased out of being able to contribute to a pre-tax traditional IRA and a Roth IRA? Generally, contributions to pre-tax traditional IRAs and Roth IRAs are phased out for high-income earners. So, what can you do if you still have excess cash on hand after funding your employer-sponsored retirement account, but you still want to invest your excess money in a tax-efficient method? Enter today's tax-saving strategy, the Backdoor Roth IRA. Let's first note that the name Backdoor Roth IRA is rather misleading. This is not a shady tax strategy. This is a completely legal and fully approved method by the IRS to fund Roth IRA contributions through Roth conversions. So to reiterate, this strategy is only applicable to high-income earners, those who have been phased out of being able to contribute to a Roth IRA the normal way. The way the Backdoor Roth IRA strategy works is this. Step 1. You contribute money to a non-deductible traditional IRA, which is not subject to income limitations. But this may be a little confusing. The key here is non-deductible. In other words, you're not going to be getting a deductible tax benefit for your contribution in the current year. Normally, when making a traditional IRA contribution, you take an adjustment on your 1040 for the amount that you contributed, therefore making that money tax deferred. In the backdoor method, you contribute to a traditional IRA and then don't take the adjustment on your tax return. Step 2, you simply take the non-deductible traditional IRA and then subsequently convert your contributed funds into a Roth IRA, making it so that money can grow tax-free for life. There are a few other additional items to note when considering the Backdoor Roth IRA. First, will you need the money in 5 years or less? Unfortunately, there's a 5-year holding period associated with withdrawals of money that were part of a Roth conversion. Therefore, make sure you won't need the money within the next 5 years, or you could end up owing the taxes you are hoping to mitigate with the conversion to begin with. And 2, what type of IRA assets do you currently have? You can only do this conversion strategy tax-free if you have no other traditional IRA assets. And please remember, there are a lot of types of pre-tax IRAs. You have SEP IRAs, simple IRAs, traditional IRAs, rollover IRAs. If you have any funds in these pre-tax IRAs when you're trying to do this conversion strategy, the IRS will subject you to an additional tax on the conversion. This is known as the pro rata rule. At a high level, the pro rata rule states that taxation of IRA accounts, when converted to a Roth, is calculated as a proportion of after-tax versus before-tax contributions. Therefore, if you have funds in a pre-tax IRA, doing the Backdoor Roth IRA will require additional tax forms to be filed and is rife with potential for tax preparation errors. Just because you have pre-tax IRA assets does not necessarily mean that the Backdoor Roth IRA strategy can't be done. It just means that you need to consider methods of emptying out these funds. This can be done either by converting all of your pre-tax IRA funds into a Roth IRA, or it can be done by rolling your pre-tax IRA funds into your work 401k or 403b. So let's recap at a high level. Steps to consider whether the Roth IRA strategy is for you. 1. Are you under the income phase-out limit? If yes, then don't worry about the strategy. Just contribute to a Roth IRA the normal way. You don't need to make things more complicated than what they need to be. However, if you are over the income phase-out limit, then ask yourself, what type of IRA assets do I have? Do I have pre-tax traditional IRA assets? If you do, you should take pause on implementing the strategy and consider the methods of emptying out your pre-tax traditional IRA assets. It's very important to know that the Backdoor Roth IRA strategy has some hair on it, and an analysis of your aggregate IRA accounts plays a key factor in determining whether this strategy is right for you. So, if you're interested in considering the Backdoor Roth IRA strategy, our team at How in Rustling is always available to help. Thank you so much for tuning in to today's episode of Street Smarts with How in Rustling.